Hello and welcome to State of the Economy. The RBI Governor, Dr. Raghuram Rajan, threw a big positive surprise last week by cutting interest rates by 50 basis points, very unexpected. And he really sort of, by doing that, threw a lifeline to the economy. Everybody was expecting interest rates, everybody wanted interest rates to be cut to give a booster dose to the economy. To discuss this and other issues, we have with us a former Deputy Governor of RBI, Dr. Subir Gokarn, who presently is Director of Research at Brookings India, a very well-known think tank. Welcome to our show.
Thank you,
Dr. Subir Gokarn. Now, so did you expect the RBI to cut by 50 basis points, considering that 90% of all those who had been polled from the industry said he wouldn't cut beyond perhaps 25 basis points.
Well, fortunately, unfortunately, I am now out of the game of forecasting policy responses, policy actions. So I was a little detached from this whole debate on what.
But informally, when you're discussing with other economists, and
I certainly felt that there was a prospect for a 50 basis point cut, although I did not think it was the most likely outcome, as it turned out to be. And the reason for that, I think, is because I expected a 25 basis point cut in the previous announcement, which did not come. And my assessment of the overall inflationary scenario is, I think, a little more benign than the RBI has been projecting. So given the concerns that were expressed in the last announcement in early August about food inflation, the weakening of the monsoon potentially threatening food prices and so on, I didn't think that was as significant a risk as was projected by the RBI. And so had the 25 basis point cut come then, I would have expected another 25 to come now. So what is being called front loading, I think actually was backloading of the August.
What should have come earlier?
What should have come earlier
has got cumulatively has come
So
now.
In a sense, the psychological impact of backloading is powerful because 50 is always discontinuously better than 25 from the viewpoint of demand stimulus. And as we've seen, virtually all the banks that all significant banks,
virtually followed up by cutting the base rates.
have actually done much more in response to this cut than they had done in response to the earlier cumulative 75 basis point cut.
Tell me, I just want to ask Dr. Gokarn, one view is, which was also articulated by Dr. Rajan, which is he probably did this, according to him, front loading, because of a gathering storm in the global economy. There is a deepening weakness caused partly by China, commodity meltdown, Japan going into recession, Europe still showing about less than 0.5% growth, and except perhaps the US, which is holding up. There is a view that if China slows further, we could be staring at another mild recession. So do you think this could have been a consideration for acting for cutting?
I'm not sure that the rationale is completely kosher here, because if you are expecting recessionary tendencies, whether domestically driven or globally, then you actually have the incentive to cut further, because then you're expecting that all of the inflationary pressures that come from outside, particularly through commodity prices, are in fact going to soften further. They're going to subside. And so you actually have a trajectory which would allow you to look at a series of further cuts,
which
because you want a stimulus.
They might have implied, right?
Could have applied.
Because IMF and other institutions are also saying that 2016 will be weak in terms of growth.
But the signal that at least I took from the policy statement was that maybe not, because the number given, the benchmark given was the real 1-year Treasury bill rate, which is indicated, the RBI indicates now that it prefers this to be in the range of 1.5% or 2%. On the day the policy action was taken, the 1-year Treasury bill rate was 7.3%. The forecast inflation for March 2016 is 5.8%. So you actually have exactly a 1.5% real rate, assuming that it doesn't change too much in nominal terms in March. Now, if that's the case, then you put these two indications together, you're really looking at a signal which says that we're going to wait and watch. This is not a situation where you can anticipate further cuts. If inflation falls further, if inflation is lower than 5.8% by March, which I think it will be, then you have room for cuts, but not otherwise.
Okay.
So I think when the use of the word front-loading was quite deliberate, it suggested that a sequence of cuts that would have happened till March have actually happened now.
And so you're reading it that way, that it may not happen?
That's the way I'm reading it, yeah.
Tell me, Subir.
But as I said, it is contingent on the forecast coming true. And, forecasts are known to have errors. So, we don't know which way that is going to go.
One more thing, Subir. This is a political issue. I remember when you were at the RBI and a couple of times when I also participated in some internal brainstorming on before monetary policy. RBI has always been concerned institutionally, concerned about balancing the needs of the savers and the investors, right? So it is not just about the industry, that industry should get a lower rate to borrow.
Right.
It's also about millions of savers who should also get an interest rate,
positive
real. Now, this is something even Rajan had talked about just 3 weeks before the policy announcement.
Right.
That there is a need to, and now we see that after this 50 basis point cut, there is talk about transmission, and for proper transmission, they're saying that the small savings rate, which is around 9% on postal savings, etc., should to be dropped and aligned with deposit. Now, how do you see this playing out?
Well, I think it's a very important structural constraint. Let me give you a couple of bits of history here. In the 2002 budget, Mr. Jaswant Singh was finance minister then, ended a series of reductions in the small savings rate from 12% to 8%. It did it over 2 budgets. And that had a dramatic impact on the treasury bill, the GSEC market, the government securities market. When rates that were as high, government is borrowing as high as 11, 12, 13, 14%, suddenly came down to maybe half that, and in fact started to slide below as the as the growth scenario sort of was quite modest at the time. Now, that suggests that there is a kind of a portfolio substitution going on. It's complicated to explain, but you can work through the links. So, effectively, the small savings rate was acting as a kind of a floor, not allowing other interest rates to adjust to basic sort of supply and demand drivers. So, now what we have is 8% is frozen. On the Provident Fund, it's actually a little variable. In fact, goes higher than that, but I don't think it's come below 8 at all. There were 2 committees set up by the Reserve Bank. The first one chaired by Dr. Reddy when he was Deputy Governor. The second one chaired by Mrs. Shamla Gopinath when she was Deputy Governor. Both of them made very explicit recommendations that this floor is proving to be a stumbling block on transmission, and we should link the rates on small savings to market. So let them vary. Let them adjust according to what is going on elsewhere. If that is done, I believe that transmission will improve significantly. And, I'm glad to see that the government is now making some, or providing some indication that this might be done. I hope that, the recommendations of these committees, I don't think we need to go back into the technicalities anymore. There's enough of this material in
So how much would this impact transmission of the rate cut onto the
I think, right now, if you take the ratio of 75 to 30 as a rough indication, I think you could effectively see it doubling. You could see it, and this is just off the top of my head. This is not based on any, any rigorous calculations that are done. But I think the fact that small savings rates will adjust to government securities rates, there will always be a premium because they're illiquid investments, would allow the transmission to be much quicker, the quantum, the elasticity.
And more liquidity would move to the banking system.
Absolutely, because then you're not getting the artificial incentive of an 8% lock-in. So you're looking as an investor, as a saver, you're scanning the sort of the spectrum of choices, and you're moving to wherever you get the best deal. So if that rigidity breaks down, people will move out of small savings into banks, and I think you'll see a much better allocation of resources across the system.
Now, coming to the other big structural problem which impedes proper transmission, which is the massive amount of bad loans, restructured loans, lying in the books of the banks. Now, you've written an article on that in Business Standard today, and you've said that something needs to be done about that. Banks need to evolve some mechanism to be able to assign some market price to these bad assets and move it so that you at least recover some liquidity. Now, do you see that happening in the existing framework?
Well, if it doesn't happen, I think the costs are enormous because I think that the asset quality issue is right now a very, very significant impediment to transmission. So whatever you do on policy rates, ultimately banks have to decide who to lend to. And when they're already carrying such a high burden of bad assets, their willingness to take on any more risk is extremely low. So they will end up offering whatever rate they want, but then, qualifying that with all kinds of risk-related parameters. So effectively, much of this money goes into government securities, which is the risk-free asset class. And the recovery that we're seeing, and there's no question that we're seeing a recovery, whatever the numbers may look like.
Marginal recovery,
But even that is in danger of being squeezed because there isn't enough liquidity flowing into business. Because the banks aren't willing to lend.
So you think this is a bigger problem, a bigger hurdle to transmission or the small savings rate? Of these two, which would you regard as a bigger problem?
I don't see them as a choice. If you had to make a choice, which I don't see why.
No, I'm not saying make a choice. I'm saying which is a bigger problem.
I think we've lived with the small savings rate for a while. So if that were to be postponed as a decision, I would be less concerned about it than an immediate prioritization of dealing with the asset quality problem. To me, it is a serious structural constraint because it just prevents banks from lending at all.
Okay.
Every additional rupee of deposit that they're mobilizing, I believe, is more likely to go into government securities than not.
Absolutely.
And so all you're doing is lending to the government. Now the government should be presumably spending that efficiently, but we know that there is private business also needs credit. So what's happening is that banks are investing in commercial paper as a way to transmit working capital to companies, but they can only invest in the upper rated categories.
So you have
high rated. So that is selectivity. That's exclusivity. Most businesses don't qualify on that score, so they're dependent on loans. And if loans are not materializing, then businesses are getting squeezed.
So we'll discuss this in greater detail, but after a small break. Please stay with us and don't go away. Welcome back to State of the Economy. We are discussing the recent RBI rate cut and its impact on the economy with Dr. Subir Gokarn, former Deputy Governor of RBI and presently Director Research at Brookings India, a very well-known think tank. So, Dr. Gokarn, you rightly pointed out that this massive amount of bad loans plus restructured loans, which is a euphemism for loans which may go bad, they are a fairly substantial chunk lying in the books of the bank, and these assets need to be banks need to assign a market value to these and maybe sell them and recover liquidity so that they are able to lend. So this is a transmission problem. Now, in this context, the RBI recently came out with a new framework called 5/25. And it essentially means that existing loans of some companies, bad loans, which are maybe recoverable in future, so the loans could be extended over a longer period of 20-25 years. And every 5 years they would be assessed, their qualities will be reviewed, all the banks would sit together. Now, do you think this framework will work? Because some people, there are critics, and Mr. Rajan himself has expressed some apprehension that this could lead to some backdoor evergreening, etc. Now, what is your sense?
I think, if you're looking at taking a forward view and saying that once we clean up the slate, what is the next set of steps you need to take to make sure that we don't repeat the problem. And the risk of repeating the problem is high because whatever we do with our infrastructure, remember that infrastructure accounts for over 50% of the public sector banks' bad loans right now. 17% of exposures, 50%.
Even some private sector banks.
Yes, but not as high. 50% of bad loans, according to the financial stability report that the RBI put out end of June. So this is a very large chunk of assets, and they're not going to be improved by any business cycle conditions because these are structural problems. So you have to find a way of getting these projects unstalled, unlocked, back on track.
Back on rail,
They're, I think, relatively good projects for the most part, which once they come towards close to a revenue stream, will have reasonable valuations. Question is, how do you get them there? And so there, I think you need a much more aggressive kind of disposition, bad bank, if you will, kind of call it a bailout, call it a bail-in. But they have to be somehow taken off the bank's balance sheets. So, in the future, if banks are lending to these projects, you might have something like the 525, which is a regular reassessment. But the fundamental issue here is that banks shouldn't be lending to infrastructure projects. Banks do not have the capacity.
Asset liability mismatch.
Exactly. Banks are short-term borrowers, short-term lenders. You need specialized institutions to lend to infrastructure. I think that's really the structural solution here. We have to move the assets off the bank's books, put them into a specialized structure or structures. We have a number of them, but their overall contribution is relatively small. One of them has now become a bank, so that capacity will also go. So let's make sure that we're not getting caught in this asset liability mismatch problem again, and not worry about banks lending 25 years, because I don't think banks should be lending more than 5 or 7 years.
So by doing it, by extending the tenure to 2025, aren't you further aggravating the mismatch?
In a sense, the 5 is probably the tenure to look at, because at the end of 5, if you have an option to offload, you have a decent price, then the bank has, this is takeout financing, which the banks were very keen on. So you have the project profile, you're willing to fund long-term projects, but you're looking for a reasonable exit at 5 or 10 years. I think that will work, but firstly the project has to be viable and has to be generating cash flows for it to be attractive to a buyer. That's the kind of transition we have to make. So right now, I think it's a combination of two things. One is banks have to be given some incentives, which I wrote about, to push this, even if the valuations are low. Because they cannot wait for the value because the project is not going to move by itself. And then you need the government to be doing everything it can.
One issue, Subir, here is that you're absolutely right that banks need to do this. There is no escape from this. As RBI has been saying, you can't extend and pretend, right? Now, but one of the things that comes in the way of selling these assets at a lower price is how should the losses be shared?
So
what is your solution for that?
Two elements. One is that we need some valuation guidelines. We cannot have managements subject to the vulnerability of being accused of underselling arbitrarily. And that's a very serious risk, real risk in our situation. The 3 Cs, CVC, CBI, CAG, all doing their work legitimately, but at the end of the day, individuals are vulnerable. So we need some explicit guidelines which allow for valuation formula, like we did in the disinvestment case. A valuation formula, valuation approach was implemented. It should be applied uniformly. You'll get some ranges of values, all of which will suggest that they are lower than the current value of the book, the notional value of the asset. Now, when banks sell these off, they should not be penalized for underselling because they followed the guidelines. Second is, the government needs to incentivize banks to do this. And I think the way to do this is the Indradhanush approach of differentiation.
The recent announcement of
the Indradhanush says that we will put more capital into banks that satisfy certain financial performance parameters. So the better a bank is doing, the more capital it will be entitled to.
But they didn't do that differentiation when they capitalized banks recently. It was one of the criticisms they gave it to everybody.
It is a part of the Indra. This is sort of partly sustenance and partly incentive. But you can build this asset disposition performance into the criteria by which you reward banks with capital infusion. So that is how you offset the loss. So who is to take the loss? Of course, the shareholders take the loss. Banks are also taking the loss. But this is one way to buffer them a little bit against the loss.
There's another structural issue, Dr. Gokarn, which I want you to talk about. You just said about, you did mention just now that there's a need to lend to small and medium enterprises. They are very vulnerable, right? This interest rate cut should actually be transmitted to them first. Now, I discovered this very interesting data point, which is that there are about 45 million micro, small, and medium enterprises who employ about 130 million, 125 or 30 million odd people. And the total loans given to them is of the order of some 5-6 lakh crore. And then you see that you take the top 10 big business houses who are into everything, infrastructure to steel to petrochemicals. Their loans outstanding are actually more than what 45 million small and medium enterprises have access. Now, do you think this is a structural skew?
I think the skew is unavoidable. I wouldn't expect even in a perfect system that the skew would not exist. The question is it excessively skewed?
10 large firms equal to 45 million small firms in terms of loans access?
Which have grown through conglomerate organizational forms, you will find the skew. So, in and of itself, it doesn't surprise me. What I think is important is, are those enterprises getting reasonable access to credit from the organized sector, or are they dependent on informal sources where obviously the cost is much higher? I think
by the way, among these 45 million micro, small and medium enterprises, barely 20% actually 30% access bank funds.
So that to me is the big issue. Not the skew. The skew may be whatever it is, but if the skew is the result partly of a lack of access, then I think we have to correct this. And how do you correct it? You need to create institutions that can actually reach out to these entities and assess their risk. Now, that last mile connectivity is where microfinance, the small finance banks, I think, will play an important role. I think the small finance banks are a very good model to extend the reach of the banking sector. And given that they are in the trenches, so to speak, they're in
and this government has created other financing systems, such as Mudra Bank, to lend to self-employed entrepreneurs.
Mudra actually will function most efficiently as a refinance entity. So the SFBs, the small finance bank lending to micro enterprises, will actually be able to use Mudra as a backstop provider of liquidity, in the same way that SIDBI was supposed to finance the state finance corporations. But because this is a much more diffuse set, I think it has that much better chance of success. So I see the combination of SFB-like institutions, small finance bank-like institutions, other microfinances which don't have the bank license but are still lending in that space, other NBFCs, localized,
they're not taking deposit, but they're lending.
Yeah, they're lending. This lot being refinanced by Mudra, if it grows to reasonable scale, I think is a potentially very important breakthrough for the financing of MSMEs. And we have to see how it works. SIDBI was a mixed success. Let's see if this one is able to overcome those problems.
Thank you very much for talking to us, Dr. Subir Gokarn.
Thank you.
That's all we have in this edition of State of the Economy. We'll be back with you next week. Thanks for watching.